In this video, I want to show you 3 signs to look for that will indicate a housing market crash. Imagine you're about to buy a house and then the monthly payments just doubled, just like that, overnight. Could you afford that? Probably not. There's certainly a lot more than just 3 indicators that indicate a housing market crash, but I want to show you what I believe are the 3 most important indicators that indicate a housing market crash. And we're starting right now. The first thing that can indicate a housing market crash is mortgage rates going up, because this is a pull and take system, meaning that the housing prices are going to go up because mortgage rates are going down. Now, if mortgage rates are going to go up, that means the prices of houses are going to be going down or plateau. I want to show you exactly what I mean. So I'm going to hop on my tablet right now and show you some numbers. Let's just say, for example, that you're going to be buying a beautiful $300,000 house. You're going to be putting 20% down on the property, and at today's interest rate, according to nerdwallet.com, it's going to be about a 2.937% interest rate. According to Chase, banks do not like it if the monthly payments on your mortgage exceeds 28% of your monthly income. While this varies from bank to bank, we're going to just use this 28% as a baseline. Now, if you want to find out what your monthly payments are going to be on this property, this $300,000 beautiful home that you just bought at a 2.937% interest rate, you can go over to bankrate.com and you can just plug in these numbers. So I'm going to pop up on my screen right now what this would look like at today's rate. This $300,000 at a 20% down payment, it's going to look like $1,000 every single month is going to be what your monthly payment is. Now, this doesn't include property taxes, this doesn't include insurance, because it varies depending on, city by city, state by state, the person, how much insurance you want to be putting on the property. This varies. So we're just going to be basing this off of the principal and the interest. You're going to want to pay attention to this because this is absolutely insane. Back in 2018, a 30-year fixed rate mortgage was going to cost you about a 4.54% interest rate. So whenever you put that 4.4% interest rate into the bankrate.com mortgage calculator, it's going to bring up, let's just say for easy numbers, $1,200 every single month. Now that might not be crazy numbers to you. Okay, only $200 a month difference. That's wrong, because this is where things get really tricky. Because if you remember, Chase said that a mortgage payment cannot exceed 28%. We're choosing it as a baseline because it varies depending on bank by bank. So we're gonna use this 28% as a baseline. Now, what does this mean? This means this is gonna be some easy calculation. So all you're going to do is you're going to divide this $1,000 a month. Again, this was what this number was at 2.937% interest rate. All you're going to do is going to divide this $1,000 a month by this 28%. You just do that by moving the decimal point over 2 spots, so 0.28. That's going to come out to 3,000. I have it on my calculator over there. It's $3,571 roughly, in some sense. Now, if we do that same thing with this $1,200 a month right here, that is at a 4.5% just 3 years ago, back in 2018. If you divide that again by the 0.28%, what banks say that they will not lend you to more than that. So you're going to need to be making, as an individual, $4,285, and almost an $800 increase in terms of your monthly income. To put that into some bigger numbers, that's almost $10,000 you have to be making extra every single year to afford that same house at $300,000, but at just a higher interest rate. Now, what if interest rates go higher than that? This is one of the most key indicators of a housing market crash, is mortgage rates going up. Why is that? Because again, like I said, it's a take and give system. So if interest rates are going up, like I said earlier, housing prices have to come down, because like I just showed you, someone has to make $10,000 extra every single year to afford the same purchase price of $300,000. Another thing that this can cause is banks loosening up the restrictions on borrowers. So instead of your mortgage not exceeding 28% like Chase is talking about, instead of exceeding 28%, they might be lenient about it and say, okay, let's bump that up to 35, 40%. Well, now we're kind of getting to a situation where back in 2018, if you remember, lenders, they were giving out stupid loans to people that cannot afford. They were very underqualified borrowers that should have not been able to borrow money. It kind of kicked us in the butt back in 2008, but I do not see this actually happening. It might happen. We might not have learned from history, but it's something to look after. Now, if you know some other things that the mortgage rates could affect, leave it in the comments down below so we can all learn something new. Now, on to the second key indicator you need to be looking for a housing market crash. But before I do that, if you're interested in the housing market, real estate investing, and personal finance, hit that subscribe button down below, click the bell icon to get notified when I upload a new video. just like this one. So the second thing you need to be looking out for is actually supply and demand. I don't think that there is any doubt that we are in a housing shortage right now. So this is also increasing the prices because it's a supply and demand issue. If there's not a lot of houses on the market, that means that they can mark up the prices of their houses and buyers will buy it because there's not a lot of supply on the market. So along with other things, the real estate market right now is actually inflated because of two things: the housing shortage we're going through right now, and mortgage rates, they're low. So this is inflating the prices. Now here is what you need to look out for when it comes to supply and demand. This is how you know that the supply is actually getting up to the demand, meaning that there's enough houses for enough buyers on the market. What you want to look out for is actually time on the market. Let's just say on average, a house is being under contract in 24 hours. So as soon as a property hits the market, it's going under contract in 24 hours. Now let's just say that's the average. Now fast forward a month, the house in that same neighborhood, it's staying on the market for, a week, 2 weeks. That's a good sign that there's not a lot of buyers on the market right now, or that the supply is actually going up. And another thing on supply demand, houses actually might be staying on the market even longer because interest rates will be going up. Again, in turn, people can't buy the houses that are higher, so then they're having to lower the prices, and then it's a housing market crash. But before I get into the third sign, go ahead and hit that like button for me, turn it blue if you're enjoying this content, because I want to make more housing market related videos for you, but I need to know that you're actually enjoying this type of content. So I know that by you hitting the like button for me. The third and final indicator is a lot of houses having PMI. What is that? Private mortgage insurance. So if you put less than 20% down on a property, you're getting PMI tacked onto your monthly payments. What is PMI? It's basically just a fancy term of saying that a bank it's their way of feeling secure to lending out to you because you're not putting down a large down payment. Just know if there's more properties that are getting PMI tacked onto their mortgage, that means that people are getting over leveraged. Because for instance, if you're getting an FHA loan, all you have to do is put 3.5 to 5% down on a property. So that 3.5 to 5% down, that's all the equity you have. Let's just say you bought it at a premium, and that 3.5 to 5% down, that's all the equity you have inside that property. Now, what if the market falls 10%? Well, now you're upside down in your mortgage. So now whenever you go to sell your property, let's just say you lose your job or you need to relocate, you can't sell the property because it's actually, you owe more than you can sell the property for. So this turns out to be a short sale situation. A short sale is an agreement between the lender and the borrower saying that they will sell the property for less than what they owe on their mortgage, and the bank will be okay with that. So having to sell your property at a short sale, that's going to hurt your credit. And not only will this affect the borrower's credit, this will actually affect the comparable houses inside that market, inside that 1 mile, 2 mile radius, because real estate prices, residential prices, are all based off of comps. So if you have exactly the same house across the street from you, and then diagonally from you, and then your neighbor, all those houses are going to be based off of each other. So if one sold for 300, one sold for 250, one sold for 275, you're going to be the average of those three. Now, if you are going through a short sale and you have to sell your property, let's just say for $150,000, well, now the house next to you that was selling for $300,000, its price will actually go lower because it's based off of the comps in the area. So the sign to look out for is increased FHA loans. You can do a quick Google search and see month to month how many FHA loans there was actually being bought. Again, if you're interested in the housing market, real estate investing, personal finance, go ahead and hit that subscribe button down below, click that bell icon, because I want to help you achieve your financial freedom sooner. There's gonna be videos popping up all right in here that I picked out specifically for you to bring you even more value than I did in this video. So go check those videos out. Until next video, I'm out. See ya.